Welcome to the TnT Podcast. It's Lindsey.
Thomas Lindsey.
I have a sore throat, so I won't be doing a lot of talking today, but we're still going to try to get halfway through the letter today as we have limited time.
All right, we're doing the 2019 Berkshire and Hathaway annual letter written by Warren Buffett. And I'll just go ahead and start reading. But I think I'll start with calling out there's a link to the Moomoo app in the description. And if you download the app and deposit at least $100, then you'll be supporting our live stream. You'll be supporting our channel here. And Moomoo has different promotions all the time, so you can follow the link and see what promotion they have for you right now. Okay, are you, what was that in the background, the noise?
I got a notification. And then I clicked on it, and it was just some spam thing that I don't want to look at.
All right, to the shareholders of Berkshire Hathaway Inc. Berkshire earned $81.4 billion in 2019, according to generally accepted accounting principles, commonly called GAAP. The components of that figure are $24 billion of operating earnings, $3.7 billion of realized capital gains, and a $53.7 billion gain from an increase in the amount of net unrealized capital gains that exist in the stocks we hold. Each of those components of earnings is stated on an after-tax basis. That $53.7 billion gain requires comment. It resulted from a new GAAP rule imposed in 2018 that requires a company holding equity securities to include in earnings the net change in the unrealized gains and losses of those securities. As we stated in last year's letter, neither Charlie Munger, my partner in managing Berkshire, nor I agree with that rule. The adoption of the rule by the accounting profession, in fact, was a monumental shift in its own thinking. Before 2018, GAAP insisted, with an exception for companies whose business was to trade securities, that unrealized gains within a portfolio of stocks were never to be included in earnings, and unrealized losses were to be included only if they were deemed other than temporary.
Yes.
Reading along with me?
Yeah.
Now Berkshire must enshrine in each quarter's bottom line a key item of news for many investors, analysts, and commentators. Every up and down movement of the stocks it owns, however capricious those fluctuations may be. Capricious. Berkshire's 2018 and 2019 years glaringly illustrate the argument we have with the new rule. In 2018, a down year for the stock market, our net unrealized gains decreased by $20.6 billion, and we therefore reported GAAP earnings of only $4 billion. In 2019, rising stock prices increased net unrealized gains by the aforementioned $53.7 billion, pushing GAAP earnings to the $81.4 billion reported at the beginning of this letter. Those market gyrations led to a crazy 1,900% increase in GAAP earnings. Meanwhile, in what we might call the real world as opposed to accounting land, Berkshire's equity holdings averaged about $200 billion during the 2 years. And the intrinsic value of the stocks we own grew steadily and substantially throughout the period.
Dang. So
Charlie?
wait, what years are these from? Just 2018 to 2019?
Yeah, their earnings went from $4 billion reported in 2018 to 81, where does it say? 81.4 billion in 2019.
Yeah. That's crazy.
But the big thing was because the stock market was down in 2018, the stock market was up in 2019.
Yeah.
Charlie and I urge you to focus on operating earnings, which were little changed in 2019, and to ignore both quarterly and annual gains or losses from investments, whether these are realized or unrealized. Our advising that in no way diminishes the importance of these
So
investments.
wait. Sorry to interrupt, but what does that mean exactly? Like, by nor the quarterly losses and gains, like Why do that? Will it explain that?
Well, he's explained it in the previous letters, so I mean, I would think you'd be able to explain it, but I know you have a sore throat, so he's saying that they're required to report unrealized capital gains or losses.
Mm-hmm.
What are unrealized capital gains or losses?
Like that. Those are not like losses that you like know about. Like
So
that,
I'll
or
give an
they haven't
example.
happened yet.
Well, when you buy a stock, you don't get a gain or loss until you sell it.
Yeah.
Or that is, you don't realize the gain or loss until you sell it.
Yeah.
So if you bought Coca-Cola at $50 a share,
Mm-hmm.
and now it's up at $60 a share, well, you have an unrealized gain of $10 per share.
Oh, yeah. Because you
But
haven't
if it goes
sold
down,
it yet, right?
but you haven't sold it. Now, if you bought it at 50 and it went down to 40,
Yeah.
well, you have a loss, but it's unrealized because you didn't sell. You're still holding the stock.
Yeah.
So you have an unrealized loss of $10. The rule change that was made in 2018 was that companies that hold equities have to report their unrealized gains or losses.
Which Warren Buffett doesn't like, right?
He doesn't like that because if the stock market is down really hard one year and then it's really up high the next year, which the stock market has a tendency of doing, it has a tendency of going really high or really low. Well, now he has to report that, but it doesn't really reflect what's going on in the businesses from an operating perspective.
Yeah.
So their businesses may actually have operating earnings of several $billion, but it gets drowned out by their equity earnings or their unrealized gains or losses.
Yeah.
Does that make sense?
Mm-hmm.
All right. So he says that he and Charlie expect that their equity holdings as a group to deliver major gains, albeit in an unpredictable and highly irregular manner. To see why we are optimistic, move on to the next discussion. Okay, so that's the end of that section. That's the intro and talking about the rule change and how he doesn't like it so much.
Yeah.
And when we read the 2018 letter, he'll probably talk about it again because that was the year that the change was made. And so, all right, the power of retained earnings. In 1924, Edgar Lawrence Smith, an obscure economist and financial advisor, wrote Common Stocks as Long-Term Investments, a slim book that changed the investment world. Indeed, writing the book changed Smith himself, forcing him to reassess his own investment beliefs. Going in, he planned to argue that stocks would perform better than bonds during inflationary periods, and that bonds would deliver superior returns during deflationary times. That seemed sensible enough, but Smith was in for a shock. So what was Smith's original thesis?
That stocks would do better when inflation was high, and then when inflation was low, then bonds would be better.
Right. Or even during deflationary times.
Yeah.
All right. So his book began, therefore, with a confession. These studies are the record of a failure, the failure of facts to sustain a preconceived theory. Luckily for investors, that failure led Smith to think more deeply about how stocks should be evaluated. For the crux of Smith's insight, I will quote an early reviewer of his book, none other than John Maynard Keynes. I've kept until last what is perhaps Mr. Smith's most important, and is certainly his most novel point. Well-managed industrial companies do not, as a rule, distribute to the shareholders the whole of their earned profits. In good years, if not in all years, they retain a part of their profits and put them back into the business. Thus, there is an element of compound interest. Keynes attempts. Operating in favor of a sound industrial investment. So there's an element of compound interest in operating in favor of a sound industrial investment. Over a period of years, the real value of the property of a sound industrial is increasing at compound interest, quite apart from the dividends paid out to the shareholders. And with that sprinkling of holy water, Smith was no longer obscure. It's difficult to understand why retained earnings were unappreciated by investors before Smith's book was published. After all, it was no secret that mind-boggling wealth had earlier been amassed by such titans as Carnegie, Rockefeller, and Ford, all of whom had retained a huge portion of their business earnings to fund growth and produce ever greater profits. Throughout America also, there had long been small-time capitalists who became rich following the same playbook. Nevertheless, when business ownership was sliced into small pieces, stocks, buyers in the pre-Smith years usually thought of their shares as a short-term gamble on market movements. Even at their best, stocks were considered speculations. Gentlemen preferred bonds. That's a kind of a clever little play on words. There was a famous movie called Gentlemen Prefer Blondes, and so him writing Gentlemen Preferred Bonds, a little bit of an allusion to that. Though investors were slow to wise up, the math of retaining and reinvesting earnings is now well understood. Today, school children learn what Keynes termed novel. Combining savings with compound interest works wonders. All right, so how is it that there's an element of compound interest for these companies that retain their earnings?
Well, every year that you invest and it grows, it can compound. Oh, you muted your mic. Oh,
yeah, I muted my mic, just sneeze, and my phone up here. Right, because they're able to reinvest the earnings that they retain back into the business to fund growth.
Yeah.
All right. Any questions or comments about that?
No.
At Berkshire, Charlie and I have long focused on using retained earnings advantageously. Sometimes this job has been easy, at other times more than difficult, particularly when we began working with huge and ever-growing sums of money. In our deployment of the funds we retain, we first seek to invest in the many and diverse businesses we already own. During the past decade, Berkshire's depreciation charges have aggregated $65 billion, whereas the company's internal investments in property, plant, and equipment have totaled $121 billion. Reinvestment in productive operational assets will forever remain our top priority. In addition, we constantly seek to buy new businesses that meet 3 criteria. First, they must earn good returns on the net tangible capital required in their operation. Second, they must be run by able and honest managers. Finally, they must be available at a sensible price. When we spot such businesses, our preference would be to buy 100% of them. But the opportunities to make major acquisitions possessing our required attributes are rare. Far more often, a fickle stock market serves up opportunities for us to buy large but non-controlling positions in publicly traded companies that meet our standards. Whichever way we go, controlled companies or only a major stake by way of the stock market, Berkshire's financial results from the commitment will in large part be determined by the future earnings of the business we have purchased. Nevertheless, there is between the two investment approaches a hugely important accounting difference, essential for you to understand. In our controlled companies, defined as those in which Berkshire owns more than 50% of the shares, the earnings of each business flow directly into the operating earnings that we report to you. What you see is what you get. In the non-controlled companies in which we own marketable stocks, only the dividends that Berkshire receives are recorded in the operating earnings we report. The retained earnings, they're working hard and creating much added value, but not in a way that deposits those gains directly into Berkshire's reported earnings. At almost all major companies other than Berkshire, investors would not find what we'll call this non-recognition of earnings important. For us, however, it is a standout omission of a magnitude that we lay out for you below. So what is he going to lay out for us below?
The earnings of retained earnings and dividends and all that stuff.
Yeah, he's going to specifically call out the retained earnings and how valuable they are. Here we list our 10 largest stock market holdings of businesses. The list distinguishes between the earnings that are reported to you under GAAP accounting. These are the dividends Berkshire receives from those 10 investees, and our share, so to speak, of the earnings the investees retain and put to work. Normally, those companies use retained earnings to expand their business and increase its efficiency, or sometimes they use those funds to repurchase significant portions of their own stock, an act that enlarges Berkshire's share of the company's future earnings. And he's talked about that several times in the letters we've read. So he has a table here. He lists American Express, Apple, Bank of America,
I
Bank of
think
New
this
York
is the
Mellon,
first time
Coca-Cola.
we've seen Wells Fargo on this list throughout all the letters.
Yeah, he sold his Wells Fargo position sometime after the publishing of this letter.
Okay.
Or
It's
of the
like
writing
this
of
is the
letter.
first time I remember seeing Wells Fargo. All the other ones look familiar.
Yeah. So you can see the retained earnings in in every case except for Coca-Cola, the retained earnings is actually greater than the dividends paid
Well,
out.
let's see if he made a good decision by selling. When do you think he sold?
You'd have to look it up. I don't know. He sold, I think it was after Wells Fargo had the scandal where they were secretly opening up debit cards for people.
Oh, yeah.
They were secretly creating new accounts for their customers without the customer's permission, because every account that got opened was a bonus for the employees or something. So employees were just secretly opening up accounts for. Did you hear about that scandal?
Yeah, I did, yeah.
And so
He,
I think he sold. I mean, I could be wrong, but I think he sold within 6 months after that scandal becoming public. Of the news of that breaking.
I'm trying to see what the internet says about that.
Well, what you can search for is, when did Warren Buffett sell his Wells Fargo stake or shares or whatever you want to call it? When did Warren Buffett sell Wells Fargo?
Let's see.
Was it said 2020?
2017 to 2022.
So he took 5 years to sell the stake?
Yeah.
Okay, well, I don't think he was selling too much in 2017 or 2018 or even 2019, but I mean, maybe he was.
Yeah, it's early 2020 is when he sold the most. Okay, let's see. Let's see where early 2020.
You can see when did he close his position, because like when did he sell all of it is kind of probably the more informative date.
I think he made a loss on Wells Fargo.
Why do you say that?
Well, do we know when he bought it?
I don't know off the top of my head. We'd have to research
Yeah.
it to find out.
Oh no, he's owned it for a long time. Never mind. He's made plenty of money, even with the scandal.
Did he start buying it in the 80s or something?
Yeah, 1989. It was like
Okay.
$2 and he sold it for like 25.
Yeah, I think he did all right.
Yeah, that's
Plus,
like,
it paid a dividend. It paid a dividend the whole time, didn't it?
yeah, never mind. I think the dividend covered how much the stock cost even.
Well, I don't know off the top of my head. I'd have to do the research.
Yeah.
But you can see how many banks he owned in this
Banks.
table. He owned Bank of
Remember,
America.
I was into bank stocks too. Remember that, Dad? I was like, look at their PE.
Yeah. He owned Bank of America, Bank of New York Mellon, J.P. Morgan Chase is a bank. He owned U.S. Bancorp. He owned Wells Fargo. I mean, shares. He didn't own them outright, but
Yeah.
I don't think he owns quite that many banks now. I know he owns more Bank of America than he did back in 2019.
Yeah.
And he probably still owns some shares in some banks, but not to the concentration level he had back in 2019. At least from what I can see. Okay, shall I continue?
Yeah.
Okay. So this table it shows that the retained earnings in every case except for Coca-Cola was actually greater than the dividends paid out. Do you see that?
Yeah.
Okay. Obviously, the realized gains we will eventually record from partially owning each of these companies will not neatly correspond to our share of their retained earnings. Sometimes, alas, retentions produce nothing. But both logic and our past experience indicate that from the group, we will realize capital gains at least equal to, and probably better than, the earnings of ours that they returned. When we sell shares and realize gains, we will pay income tax on the gain at whatever rate then prevails. Currently, the federal rate is 21%. It is certain that Berkshire's rewards from these 10 companies, as well as those from our many other equity holdings, will manifest themselves in a highly irregular manner. Periodically, there will be losses, sometimes company-specific, sometimes linked to stock market swoons. At other times, last year was one of those, our gain will be outsized. Overall, the retained earnings of our investees are certain to be of major importance in the growth of Berkshire's value. Mr. Smith got it right. All right, I think we can call it there, and we'll continue it next time. I want to talk to you some more off the stream.
Okay.
I think that's a good place to call it.
Okay. We'll call it off here. We'll get to part 2 next time. Thank you.
Remember to check out the Moomoo app. Download and fund it.
Peace out.